We turn to the first of two segments on what's on the agenda when President Obama meets with China's president tomorrow at the White House. First News Hour economics correspondent Paul Salman updates his ongoing coverage of a key dispute between the U.S. and China over currency and trade. It's part of his reporting on making sense of financial news.
One dominant issue at the U.S.-China summit, the Chinese policy of holding down the value of their currency, which continues to give Chinese products and companies a supposedly unfair competitive edge. U.S. officials have long pressed their Chinese counterparts to let the currency, the renminbi, rise in value, sometimes making the case more forcefully than at others. On Friday, Treasury Secretary Geithner said the renminbi had made substantial gains, a more forgiving stance than he took just 2 days earlier.
Now, we believe it's in China's interest to allow the currency to appreciate more rapidly in response to market forces, and we believe China will do so because the alternative would be too costly, both for China and for China's relations with the rest of the world.
And Secretary of State Clinton.
We need to open up more opportunities for American manufactured goods, farm and ranch products and services, as well as allowing currency to appreciate more rapidly. These reforms, we believe, would not only benefit both our countries, but contribute to global economic balance, predictability, and broader prosperity.
Net-net, you have seen a small move lower in the dollar, but not appreciably so.
Back in November, David Steck, who runs the foreign exchange desk of Nomura Securities in New York, showed us how the dollar had been faring against the Chinese renminbi.
So here you're looking at a long-term chart.
For many years, China glued its currency to the U.S. dollar. But starting in 2005, China loosened its grip, letting the value of the dollar fall against the renminbi, some 20% over 3 years. But in 2008, the world financial crisis hit, and China re-glued the renminbi to the dollar. In the aftermath, China has recovered, while the U.S. economy limps along, our unemployment rate distressingly high.
The U.S. wants this to happen, this move right here. We want to get back on this path, that the dollar go down in value against the renminbi.
Because we can then sell more exports and import less.
Correct, and perhaps preserve some more manufacturing jobs.
But that's just how China looks at it, says MIT economist Yasheng Huang.
The Chinese export sector is a large employer, and they tend to be larger in terms of employment as compared with companies that don't sell abroad. So when Premier Wen Jiabao said that the currency appreciation is going to have a very substantial negative effect on employment, I agree with him.
But how exactly does China control the value of its currency? Certainly not in markets like this.
Every day at 9:15 Beijing time, the central bank, the People's Bank of China, in conjunction with SAFE, who's the State Administration for Foreign Exchange, issues a circular to all the banks in China. And what that circular says is this is going to be the reference rate of the dollar against the renminbi for today.
Suppose the Ford Motor Company buys some Chinese steel, says David Steck.
Ford pays China Steel, say $50 million. So China Steel now has $50 million. Now, as a Chinese company, you want your own currency. The state bank will then issue renminbi to the steel company in exchange for those dollars, and then the state bank will go to the central bank to exchange those dollars.
So China's central bank amasses the dollars paid to Chinese companies, hundreds of billions of dollars a year. If it simply spends them, the bank risks flooding the world with so many dollars, the demand for them is bound to go down. The dollar would then drop in price.
So they have to put those dollars somewhere. Those dollars are being put in the deepest, most liquid market in the world, which is the U.S. Treasury market. That is where you have this very circular logic of China running big trade surpluses, the U.S. running big deficits, but they're interlinked.
Because China is lending us the money to run our big deficits.
One interpretation is that China is basically lending us the money to buy stuff from them.
And to some, this is the road to ruin. This graphic futuristic fear video went viral before the fall election. It's about the rise of China, the decline and fall of great empires like ours, which overspent, says the Chinese professor. No surprise that America became hopelessly in debt.
我们是他们的大债主，现在他们都得给我们干活。
That's one view of the Chinese, but they say they're just being prudent, controlling their currency to keep hot money from overheating their economy.
Money that goes back and forth very, very quickly. They bid up prices, they buy up the real estate assets, they buy up stock market assets, bid up the prices, and then they have a catastrophic fall, right? That's the fear.
But in actively discouraging hot money by forbidding the open trading of its currency, China opens itself to the now familiar charge.
If China keeps its currency artificially low, that means its products are artificially low, its companies get the business, and it takes jobs from the United States.
Having a trade deficit for the United States is a function of this country simply consuming beyond its means.
So if China's goods were more expensive than they currently are, you think the United States would still be borrowing money?
From India, from Vietnam, from Brazil. I'm not saying I agree with Chinese completely. All I'm saying is that it is very difficult to make the argument with Chinese and say, you do something about your exchange rate. But by the way, we can spend the way we want, right? So that's not a winning argument with anybody.
Meanwhile, the Chinese authorities have had other economic concerns of late, according to Chinese economist Geng Shao.
China has been very much concerned about the cost increase, inflation, wage increase, property price increase, raw material price increase, and all those means that the Chinese companies, exporting companies and other companies are losing competitiveness.
And, says Professor Geng, whom we met at the annual economics convention earlier this month, those inflationary cost increases in wages, in raw materials, in property prices will inevitably make Chinese products more expensive. As it happens, this is the very argument Secretary Geithner has used to convince the Chinese to revalue their currency. Because, he says,
if China does not allow the currency to appreciate more rapidly, it will run the risk of seeing domestic inflation accelerate, as you are already seeing, and will face greater risk of a damaging rise in asset prices.
But Professor Geng says it doesn't matter because Chinese inflation or Chinese currency revaluation have, in effect, the same results.
Basically, the Chinese income is rising, Chinese price levels are rising, and the U.S. income is stagnating, right? So the two are converging, and that's what we expect. And this will happen no matter, what the Chinese government want or not. So if we just have a little bit more patience, everything will actually fall into places.
That may be more nearly China's position on the currency issue than the administration's, however, as Hu Jintao comes to visit America.